Amazon stock has been on fire lately, jumping over 5% after announcing a massive $38 billion deal with OpenAI to power their AI workloads using hundreds of thousands of NVIDIA chips. But with AI deals flying left and right, from Oracle to Broadcom, and OpenAI spending now projected to hit $1 trillion by the end of the decade, are we looking at real growth here, or just another leg in the AI bubble? Let's break it down and find out if Amazon's stock price still makes sense at these levels, or if investors are getting ahead of themselves. Let's get to it. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna go over Amazon. We have been talking about Amazon before, but not to the extent of AI much, right, Kirill? Mostly about computing and stuff like that in the past, mostly Amazon web services. But today, another AI bit for you guys. And as you guys are well used from us by now, we have 3 segments. We will go over what's in the news. We are going over the company fundamentals of Amazon. And lastly, the value that you're going to get out of this video, the valuation of Amazon. But as per usual, guys, this is not financial advice. We are just having fun here, just trying to make sense of all these price jumps in the last 2 weeks. So yeah, this will be the starting point of your own due diligence. Kirill, what's in the news?
Yeah, all sorts of fun. I really like your types of fun, you know. But if we're talking about the news, when it gets to Amazon, yes, indeed. So Robin just mentioned 38 billion of investment has just been announced by Amazon. So it's a partnership with OpenAI, and as you can see in the title, again, it's another, let's say, situation where more and more investments are happening between the bigger, like these circle of companies. So we're talking about Qualcomm, we're talking about Oracle, NVIDIA, Microsoft. They're all doing it in different ways, of course. And also we have seen the feedback from one of our viewers on our previous video. Good to know. Really appreciate a lot of input. Thank you so much, and please, guys, again, feel free to comment, share your thoughts, ideas. We're always reading, we're always watching what you're saying, and we really appreciate it. Anyways, coming back, yeah. So basically, on these news, whenever there's AI in the title, in the headlines, then of course the stock go crazy up, especially if there's a deal happening, and that's what also happened to Amazon stock, as you can see. So it went up around almost 5% today, as we are filming the video, and it's also skyrocketed from around 220 range up until 255 at this very moment. I think that was on Friday. I think it's also related to more or less the same rumors related to the AI deal. So pretty good, pretty interesting move from them. Of course, it's kind of sensible as well, considering them being a powerhouse. When there was an outage of AWS, maybe, Robin, you've also seen the memes where half of the world just was not working anymore just because of AWS, which is, of course, concerning, but it also means that Amazon has such a great moat and such a competitive advantage that half of the globe is using it. So it's pretty cool. It is pretty interesting. And of course, in the light of AI deal, we also thought it would be a good idea to visit the Amazon valuation once again, just have a look and see if anything changed. And also, of course, speculate a little bit on the AI and how much did it already boost the stock price and if it's justifiable or not, of course.
Yeah, and before we go into it, Kirill, I think you had another article open about that AI is not really contributing to a lot of profits and such.
Yeah, basically exactly in line with what we've been discussing in our previous video. You can also maybe check it out. It's talking about Qualcomm. We also got curious in terms of like the return on investment on all of these AI investments, and probably maybe seen it before, but there has been a research conducted by MIT. And what they found is that 95% of organizations found zero return despite enterprise investment of 30 to 40 billion into generative AI. So what it probably means is that we're kind of probably seeing something similar to what it was with the dot-com bubble, where people are just putting a lot of money, a lot of interest, and a lot of investments into the topic, which is great on its own. But because of the fact that the more the hype is there, the more people are willing to invest in it, the more valuations are then getting sky high and unreasonable. It doesn't necessarily mean that the investments into AI itself is bad. It means it's just getting a little bit too heated up, this whole sector. And it's also maybe something for you guys to keep in mind, you know?
Yeah, exactly. And these are all, of course, short terms thought points, right? So in the short term of things, you won't see a lot of returns quickly, even though investors might think that will be the case. So yeah, we will see these returns coming on later in the life cycle of this new technology. But Kriel, we're not here to talk about macroeconomics for AI. Let's dive into Amazon.
Yes, sir. Yeah. So to start with, of course, a lovely green number today, good to see. But also, we can see a 930 score of C, and it's primarily driven by great revenue growth, of course, no doubt about that. Amazon has been really great. I think we discussed it later before that they're really good with reinvesting also money back into the business, and they're doing it quite efficiently and effectively. That is why we still have more or less pretty solid gross margins, driven most likely by AWS. But operating profit margins are still, let's say, could be improved, of course. But then again, you always have your Amazon marketplace, which is highly expensive in terms of operations. So that's why they're really good at making a lot of money on AWS, on, let's say, software-based products, and then subsidizing their other businesses that need cash flow. So, for example, again, the marketplaces I mentioned. But yeah, so far nothing unexpected, to be honest. All makes sense. Like a good, solid tech firm, I would say.
Yeah, we have seen higher scores, but this is just average, so nothing to complain in the first section. When we are let's just dive deeper. So we see some gross margins of 50%, which is insane. Operating margin 12%, good. PE ratio of 35, which is on the higher side of things, but it's not too insane. We have seen much higher numbers, especially if you want to get some exposure to AI. You might be looking at, for example, Nvidia, which has like way higher PE ratios. Also, completely different industry, but I mean it gives some kind of comparison here. But yeah, 35, not that high. What do you think, Kirill?
Yeah, totally makes sense. I mean, for such a big company, there are, of course, opportunities for growth. Again, it's just a matter of which areas, which sectors we're talking about, because they also invested in other, venture businesses, like, for example, iRobot, so that they can stimulate more sales in the marketplace. But there's still probably quite a few more opportunities, so that's why they're also jumping on the AI part to see if there's any efficiencies to be gained as well. But overall, let's say 30, again, considering the current market, it's reasonable. It's not some crazy P that many other companies are, let's say, having at the moment.
Yeah. So looking at the average revenue growth, and also keep in mind, guys, this has been for the past, I don't know how much information we have on Amazon, probably more than 15 years. So
from 2005.
20 years.
20 years, yeah.
Yeah. So these numbers for the company foundation are taken on all the whole data set that we have. So just take them with a grain of salt. But yeah, I mean, over the past 20 years, they have doing some solid work here with average revenue growth of 24%, which is it's really impressive. Their long-term debt is covered by their free cash flow, which is nice. They also have what do they have? The free cash flow growth of 30%, so in line with their revenue growth, which is nice. It's not out of whack. Let's say sometimes it's crazy how they grow the free cash flow without growing revenue, but this is just aligned. Net income growth has been negative, but it also has probably to do with 20 years of data. I think if you would take this over 5 years, it might look completely different. And a share buybacks has been minus 1.27%, which is diluting a little bit, but also we will see where that happened. Might be at the beginning of this venture.
Yeah, exactly. And I think also for the past 2 years, the net income growth has been significantly improved. So we can also, you can clearly see it also from the perspective of pre-tax income. It's just literally going ham. Starting from the net positive of 1.5 billion and now it already at 77. Literally in a matter of 10 years, it's a no-brainer, to be honest. It's amazing to see. And you can also see that there's exactly the same pattern happening with revenue, gross profit, and pre-tax income in this case. Of course, they have a bit of R&D expenses going up as well, so already to 91 billion US dollars. Of course, let's say it is good to keep it more or less stable or ideally even declining, but again, because of the nature of Amazon, they have to keep up with development on the AWS side, on some other products they offer, so it's pretty much understandable on this area.
Exactly, and we'll just check in a bit the ratios and see how much the research and development is on the grand scheme of things, which gives a better perspective, in my opinion. With the shares outstanding, do we see a slight increase still?
We can also check at the percentages just a moment. So shares outstanding, there's really slight increase. So they're diluting you bit by bit, 1%, let's say, a year. So of course, again, it's a growth stock, so this is also how they raise a bit of equity. But on the other hand, if you're a long-term investor, it's gonna you will see accumulation of it. But I guess in the grand scheme of things, if it's a percent or two per year for a high-quality company, it's okay. It's fine.
True, but then you also have to understand that they do not give a dividend, which is also good that they reinvest in the company, but they are also diluting, so meaning that they don't really have some shareholder incentives other than the promise of growth. And like Rio said, it's a growth stock, so that makes sense. But preferably, when it matures, you would like to see a shift where they would go after more pleasing the shareholders. But I guess they have a lot to invest in these days with AI and their Amazon Web Services. So yeah, no complaints here per se, but it's just something to keep your eye on. And also, like I said, this is the start of your due diligence. So go into their financial records and see why they are increasing shares and what they wanted to buy. Did they want to take over some companies, or did they need some more, like Kirill said, some more equity on their balance to make some big purchases? Just check it out why they are doing these things. And when you know, and it feels good for you, then you can jump on it. But Kirill, talking about jumping on it, let's jump on the research and development. You quickly go up again.
Yes, of course, yes. Research and this one.
Yeah, so it's below 40%. In the latter years have been below 30. So that's, like Kirill said, that's the mode. So they have been slowing down on their investments because they notice that they don't need to develop as much as they need anymore. So that's a good sign.
Yeah. The only trouble, of course, is when you get too big. It's really hard to grow in the double digits format as it was before. So you can see it on the revenue growth chart. You probably have to anticipate that the growth is gonna slow down, but then again, because it's you're starting with pretty high, let's say, comparison point of the previous years, then even growing 5% or 10%, we're talking about billions of dollars, which is already great. But it would be probably a little bit hard to expect Amazon doing double-digit growth over and over and over for the upcoming, let's say, 15 years. Unless they would jump into something completely radical, some new business that is, like, gonna really revolutionize them as a company and so on and so forth.
Yeah, exactly. And these things, for example, a good case study of this happening is now with Apple, right? If you want, you can check out our video that we published a while back. But it's becoming more or less of a cash cow, and you see that they have increasing incentive programs for shareholders. So now they are big. They just don't grow as much anymore. Shareholders, they don't really expect them to grow anymore. They're just holding the stock now for share buybacks and dividends, basically. So yeah, as Kriel said, just keep in mind that it won't be growing as much as it did in the past. So when earning call comes around, just make sure that you know this information, that investors might give Amazon a slap on the wrist if there's so much hype in the market.
Yep, fully
And there is
agree.
a lot of hype in the market, but yeah.
Yeah, indeed, especially with AI. So it's good. It's good for their stock appreciation at least.
Exactly.
Yeah. Right. Is there anything else you would like to add on these?
No, just the growth that they are growing their gross margins.
Yeah, quite
which is great.
consistently as well. Yeah.
Yeah.
So they really started from the lows of 20 back in 2005, and they really improved it to 51 already so
Yeah.
far. So that's great. And then, of course, it's a more or less respective situation happening in the operating profit margin as well. So they're
Yeah.
really improving it from the lows of 0% in 2014, and then it's already improved. So it's the best situation they're at the moment since 2005, actually. So that's it's pretty good. It's pretty good to see,
Yep.
to be honest. So shall we get to the most important part?
For sure. Let's go to the valuation. So if this is the first time that you're watching, we'll just talk you through our valuation formulas and methods that we do, and it gives you a clear picture on how to use our app, and also to calculate with us how we get to the valuation that we are about to receive from said application. So we can base our valuations based on 3, 5, or the maximum amount of years in our data set. So yeah, you can see that things are about to change. I think for now 3 years is the most applicable for our case study, right? Because it's the most recent. There's a lot of developments constantly in this space. So I would say just make the assumptions based on the past 3 years. You can also see that the growth won't be as crazy as if we do, for example, the max amount of years, as Kirill already mentioned, which is a bit more realistic, right, in our approach. Also note that Kirill and I's assumptions are mostly conservative. So also, of course, if you want to do a more aggressive approach, you can also, have a trial on our application and do it yourself. And of course, share your results with us in the comments. Okay, Kirill, so let's get to it. So for the free cash flow starting point, we always use last year. It's the most recent data that you can calculate with. But if you want to do something different, if you have some more details, or if you want to try something else, then feel free to adjust it. The projection period, it's always with big tech, it's a bit difficult, right? It's not per se a cash cow yet. I don't see Amazon going anywhere in, let's say, the next 10 years, but it's also highly volatile, and the growth that we can expect from these things are also quite volatile. So what do you say, Kriel? 2, 3, 5 years?
I think we can do, let's say, 7, and with the revenue growth of, let's say 5, because the rationale behind it is pretty simple. So if we assume that the economy is going to be doing more or less the same as it is, unless we're going to have some crazy crisis which is going to remove the demand from the services and products of Amazon, because it's also really heavily based on the improvement of the situation in a big corp, right? So everyone, if they want to go cloud, if they want to spin out more servers, they would need AWS. But also, if an average consumer is not shopping anymore, they're not going to be using Amazon Marketplace either. So that would pretty much be simple. So then we're not going to have too much growth in there. But if, let's say, it's going to stay more or less the same, I think it would be pretty logical to say that the company is just going to gradually become cash cow, as you, Robin, mentioned. They're probably going to improve even further on their bottom line, and they're going to say, okay, we're going to probably do some share buybacks. We're probably going to do some maybe dividends initially, or we're going to pay down debt that they have a little bit of it. So I think it's gradually going to become a cash cow, and I don't think it's going to be more than 5% growth, just let's say inflation plus a little bit growth on top of it.
Yep. All right. So 2 down, Kriel. For the discount rate, we usually keep this at 10%, but you can, of course, fiddle around with this as much as you like. For the projected PE ratio, well, we can look at what the PE ratio has been for the past 3 years, which is 41, which is quite high. We already see that it's a bit lower these days, right? 33. We just saw it in our application. Um, so given that trend, yeah, hovering around the 30 would be conservative, but also I think a bit more realistic,
Yeah,
unless they have some more crazy news
35.
coming out constantly every week. New AI booms.
Yeah, and to be honest, you're right. It's because it's a big company. Any kind of news related to it, they're probably gonna make some movements in the stock. So you can kind of assume like even some marginal thing that can happen, they're gonna just create some big fuzz about it within the investment community. So yeah, I think 30-35 is quite okay to start with, and then again, as I mentioned, over time we can also adjust our assumptions, and we can see maybe what is the higher or maybe more realistic or more optimistic view on the stock
Yeah.
could be.
So for the required rate of return, because you're stock picking, you want a bit more, reward because you're having a bit more risk. If you would have an ETF, for example, you would expect between 7 and 10% returns, or somewhere in the ballpark. But because you're stock picking, you can do whatever. If you want 20% return, you can put it in. But of course, the value is going to go down on when you can jump in on the stock. We normally keep this at around 11-12%. Again, just to be more on the conservative side here. Margin of safety, yeah, this depends on your knowledge and your risk tolerance, basically. So if you know a lot about Amazon, if you know everything there is to know about Amazon, you have read all of their annual statements, you're best buddies with Jeff Bezos himself, then of course feel free to put in 0. But you want to have some kind of margin of safety that all right, if the stock is within the margin of safety, it's already undervalued and you have a margin of safety here. But Kirill, I think we are quite known or familiar with Amazon at this point.
And I'm playing Padel with Jeff Bezos every now and then, so yeah, of course I don't need any safety on that, so well, totally fine. But just for the sake of the exercise, we can put in, let's say, 15%, just to see how it looks like. Yeah. And then what do? We hit the analyze button. Yes, sir. Oh, okay, that's pretty interesting. So what we have here is, of course, pretty low figures on our left side of things. So the Warren Buffett rule of thumb formula makes sense, and Ben Graham's as well, because they don't really apply very well on the tech sector nowadays, especially because it's pretty heavily inflated now, and it's really different environment than what it was back in the days. Discount cash flow formula is pretty low. Also, of course, because the cash flow is only just getting improved only recently in the past couple of years or so. So that's why you cannot really also trust this one too much. Target valuation formula is a little bit higher than the current price, which more or less makes sense, because we're talking about, okay, more or less realistic future growth on the PE and EPS, and on EPS Amazon is doing quite well, actually, and because again we're assuming 7 years. And the NPV formula is in the range of 140. So I would probably say that it would be nice to, if there would be opportunities, of course, to do that. I would probably start picking up the stock around maybe 200 ranges, especially. Let me try to look at the graph. Yeah, so the last low that was in there, so let's say you can pick up at the range of 200, and if it goes lower down to, let's say, 170, 160, I think that would be a good place to find the dip, if you're just talking about the levels. So I think that would be my at least targets if I would like to pick up the stock again.
I was thinking maybe it's also a nice exercise, because we don't often do anything with the analyst point of view. But if we just swap out the growth that the analysts expect towards what we did.
Yes.
So they say for the current year it's going to grow with 27%. Sure, fine, whatever. But they are stating that the next year, it's going to grow with 11%. So if we do the estimated growth rate of 11% for the next year, so
Yes,
it's
within
twice
2
as
years.
what we're. I'll just leave everything the same. Just remove.
Okay,
Let's just
sure.
keep the 7 years, but let's just assume that it's going to grow with 11%.
Yeah, then of course your target valuation formula is gonna merely double, but then again it makes sense because you double the growth rate and the NPV of 177.
Exactly.
So
But
it also
just as
improves a bit.
but just as an exercise, so this is just to showcase that um, uh, our approach of valuation is very conservative. So you're gonna get conservative numbers, even though it's in more or less in the range of possibilities, right? Looking at our valuation formula and the MPV formula. But if you trust the analyst from Yahoo Finance, and that's also another discussion that you can go into, how their track record is, right? But if you trust them, then Amazon is basically a steal. If you just focus on the target valuation formula and the MPV formula, you would already pick this up at what's the average, like $300. So then it would still be undervalued, and you would still have some kind of 10%, um, um, yeah, margin of safety. So just saying, just showcasing the flexibility of our application here. And we were talking about the flexibility of our application. Where can our lovely viewers get their hands on maybe a trial version of the application?
Yeah,
Or
just also before we do that, yeah, because the reason why I wanted to also highlight one more thing, I actually recently sold Amazon stock. I put the target sales price of 250, I think exactly. So it was right when the first spike was on Friday, and I picked it up in the range of $190 per share. So that was, I think that was my target, and that was happening, let me look at it, in the more or less in the beginning of the year. So it was in March, yeah, more or less March. So yeah, and I would, to be honest, I would also be more than happy to pick it up at the same range. So yeah, and now, of course, yes. What was the question again, Robin? I do not remember.
where can our viewers get their hands on this app?
Oh yes.
Either as a trial or
Oh, you can already get a deal. Oh my god. But yeah, you go to 930.com. So the link will be, of course, in the description. Robin will make sure to add it. So what we got, so what we offer is 20 years of data. Whatever you have seen already, plus there's a watch list, plus there's a screener, and we're gonna have way more updates soon, hopefully. So if you want to lock the price already, you can do that, because then we're gonna bump up the prices later on for our packages. But also, if you just wanna have a look at it yourself, you can have a free demo. You can just play around. You can sign up for free just to try out 5 stocks on yourself, just to get a feel of it. There are a bunch of explanations throughout the app, as you can see on the GIF. So you can kind of also familiarize yourself with the terms and what all the things mean. So 930.com, have a look. Off you go, and please let us know what are your thoughts on this video. If there's any other company that you would like us to look into, if you have any feedback, we'll really be happy to take it up, because that's the whole point. We would love to improve, make it better.
yeah, nice, Grill. All right, and then thank you for this monologue. Thank you for watching, and we'll see you guys in the next video.